Hello, thank you for watching. I'm Sam from My Mortgage Angel, and in this week or month's episode of Ask the Expert, I've got the wonderful Kelly Worthington from Later Life Freedom. Thank you for giving up your evening, Kelly. We're recording this on a really sunny evening. It's the 1st of May 2024, and I think we'd probably both rather be outside in the sunshine right now, wouldn't we?
I know, that's commitment, right?
Shows how much we love our jobs.
Exactly.
So I met you at my Women in Business Network in the Lee group, I think. And
yes,
I think even from the moment you walked in the room, I think we realised that we had this connection. Firstly, we've both got a little bit of a quirky style about ourselves.
yes.
But your passion for your clients just comes through from the moment you open your mouth. I can tell that you're absolutely dedicated in doing what's right for your clients, and that really resonates with me. So just for those of you who don't know me, I'm Sam from My Mortgage Angel. We offer fee-free mortgage advice in Benfleet. We can do all sorts of mortgages for you, but we don't do later life lending, and that's where Kelly specialises. So Kelly, I'm going to let you introduce yourself.
Okay, thank you. Very exciting, a little bit nerve-wracking. So I'm Kelly Worthington, Later Life Freedom, and I'm based in Rochford in Southend. So pretty much like you say, I've got access to a provider different to your standard mortgage, which is what you specialise in, so the later life lending, which obviously we'll go into more detail.
Okay, we glitched a little bit there, but I heard everything that you said, so we're just going to keep going with the tech. Okay, and I think there's a little bit of people are a little bit scared about later life lending, aren't they? Because I think maybe it's got a bit of a bad history. I know certainly before I was chatting to you and other people in the industry, I kind of shied away from it a little bit myself because there has been some bad things that's happened. But it's a lot more regulated now, isn't it?
Yes, 100%. So years ago, when it was unregulated, there was lots of concerns. There was lots of I don't know if that's the right word, ripping old people off, which is what people were saying, but actually that isn't the case. And now it's become regulated. There's a lot more protection in place for the customer. I always treat every customer like it's my nan and granddad. So I'll always understand exactly what they want to then obviously move that forward. So there are lots of bits around it. And I suppose the one thing that you can't fluff up with equity release is if you do not pay the interest as you go and you decide to roll that up, then it does eat into the equity of your property. Yeah. That doesn't change, and that's sometimes what can put people off. But there's pros and cons to that, which we can obviously go into.
Yeah, sure. Okay. So the purpose of this video, and I want to make sure that my compliance team sign this one off, so I'm going to try and do it right first time. We're just going to talk about the differences between the mortgages that I do. I'm going to call them normal mortgages. I mean, there's no such thing as a normal mortgage, but we're talking about residential mortgages, we're talking about buy-to-let mortgages, the differences between the mortgages that I do all day, every day, and the mortgages that you do all day, every day, Kelly. So
yes,
we'll do a bit of a, right, in this scenario, this is what mine would do and this is what yours would do. So it will all just work out and be fine.
We'll go with the flow. I'll be led by you. The floor's yours, Sam.
Oh, goodness me. Right, so I think the first point of difference is affordability. So from the normal mortgages that I'm organising, the affordability is based on, let's talk about residential mortgages. These are based on how much you earn, less your fixed outgoings. So I'm going through pay slips, I'm going through bank statements. We're looking at debt history, we're looking at credit score, and then the lenders are making their decision about how much they will lend. Kelly, how does it work in your space?
So it's the total opposite. So I always say to yourself and other mortgage brokers, if you've got a client that's the minimum age is 55, that's really important with equity release, because if you're younger, you can't take out equity release. And if you're in a couple and one of you's 60 and one of you's 53, you can't do it because, yeah, put my teeth in, the youngest person, minimum age is 55. So that's really important. And what it's based on is your age, your health, you and your property. So it's got nothing to do with affordability. So it is completely different. It's not based on earned income, because in later life, 9 times out of 10, you've not got earned income, it's pension income or whatever that later life income you've got coming in. So that's not factored in at all. That's the main difference.
So there's a surprise for me already. 55, I mean, I'm just approaching 46, so 55 to me seems really young still.
9 years and you're in. Yes, it is young. It is young for equity release. And one of the things is, whilst it can be considered, the younger you are, the less you're likely to be able to borrow against your house, because the likelihood is you're going to be around for a lot longer than if you're an older person, let's say late 80s or something, you're not potentially going to be around as long. So that's why they'll lend you more. Okay. Such a lovely topic, this one.
And is there, going off script here already, Kelly, I'm sorry, is there any maximum age that you can apply in your space?
No, we should be able to work. I think, I'm trying to think of the oldest that I've done. I can't think of the top of my head, but no, there's no maximum age. Some lenders might have a maximum on certain products.
Yeah, sure.
But on a whole, no, we should be able to cater for all.
And we can't talk about individual lenders anyway, because compliance will definitely have my guts then. So
no, that's why I worded that carefully.
Great, okay. Right, next topic we're going to look at are payments then. So payments on a residential standard normal mortgage, not that they exist, you would have to make a monthly payment every month. Even if you took an interest-only mortgage or a repayment mortgage, there's that commitment to make that payment every month, which I think is why those mortgages are based on your income less your fixed outgoings. Kelly, I think it's different in your space, isn't it?
Yes, there's a bit more flexibility. So you've got options. So with the equity release, you can choose to not pay anything and roll that interest up. By rolling that up, it is compound interest, which means that's interest on interest each year. So that's something to be mindful of. So if you've borrowed 50,000 and then when the time comes for you to go into long-term care or you're no longer with us, if you've not paid that interest, the original 50,000 in that example I've just given, plus the accrued interest, the lender wants back, and then whatever's left then goes to your estate. So you've got that option. The other option is you can set it up and pay the interest each month. Now you can pay all of the interest, you can pay part of the interest. You can pay some of it, and then your circumstances might change 3 years down the line, and you want to stop it. You can do that as well. So you've got that big flexibility. This is a new thing that's come in with equity release, where lenders allow customers to overpay up to 10% each year. And as long as they don't exceed that, there's no charges. But it tends to work out, if you work out the rate and that interest only per month over the 12 months, it's like an interest only mortgage, I suppose. But you've got the flexibility where if you're normal mortgages, they can't stop whenever they want. They're contracted. They're not with equity release.
Yeah, absolutely. So that's another real major difference between the two. Okay. Right, let's talk about mortgage terms then, because I mean, it wasn't so long ago that the maximum mortgage term was 25 years on a residential basis. That has now increased to 40 years. Obviously, different lenders have different rules, but the maximum I've seen is 40 years. Kelly, that's different in your space.
Yes. So with an equity release, it's a fixed rate for the lifetime of that mortgage, and that means, as I've just mentioned, if it's a joint application, when the last man standing goes into long-term care or is no longer with us, that's when the mortgage ends. Now, when you get what's called the illustration, which breaks the product details down, on that illustration, the lenders give a rough estimate of how long they think that you're potentially going to live, so that we put an age in and they'll give you a rough estimate. So that can be depressing, can't it?
That sounds awful.
But let's say it says, I don't know, 15-year term, for example. Never get hung up on a term when it comes to equity release, because at the end of that 15 years, you might be still fighting fit and going strong. That doesn't then mean you lose your home and you've got to pay that back. The mortgage just carries on with you. So it's for illustrative purposes. They put a term in so you can see how much you're going to be paying back and things. But technically, there is no term. It is fixed for the lifetime of that mortgage, of you, your lifetime.
Okay, that's clear. Thank you. And then I think the last thing that we agreed we would talk about, I'm not sure if anything else is going to come up. You never really know with me. Is about the deal length. So I talk to clients about, do they want a 2-year tracker rate, a 5-year fixed, a 10-year fixed. Depending on their situation, we always look at what the options are. But again, I think that's different in your space as well, isn't it, Kelly?
Yes, so it goes back to it's fixed for the lifetime of the mortgage. But what could scare people with that is, well, what if in that lifetime of the mortgage I need more money? So with a standard mortgage, you do your 2-year, 5-year, whatever you're doing, you can then review your options. And if you need more money, that's what you'll look at, subject to affordability. Where with my side of things, with the equity release, it can it's a tricky one. You can do a further advance, but it will be available on that rate at that time. So not to go too much and confuse people here, but what I tend to do is understand how much they need now, so a lump sum and what they need it for. And then what lenders do offer now is a drawdown facility, where it means that, again, it's usually 50,000 for argument's sake. They need 50,000 lump sum to pay off now, for whatever reason, but they might want 50,000. I call it like an overdraft facility that's sat there. It's been agreed up front, and then further down the line, if you do need more money, you can just approach that lender directly and draw down as and when you need it. So that way, you're not paying interest on money you're not using. And if you don't use it, you don't pay for it. But it just gives you that little bit of comfort in case you might need money further down the line.
Yeah, that's really interesting. So going off script again here, then, you said you need to know what people need to use the money for. Obviously, with a standard mortgage, it's for a purchase, or if you're borrowing more money for home improvements or whatever, there are restrictions on what you can borrow money for. Are there any restrictions in your space?
No, not really.
You don't need to tell me what they are, because again, we might be getting into detail. But
no, as long as it's legal.
fine.
So I guess let's put this a little bit different. The main things why people are looking at equity release at the moment is if they're on an interest-only mortgage, on the normal mortgage, so your side, and they've reached the end of their term, but they're at an age where they can't go any further because of affordability, and the lender wants their money back. They don't want to downsize because that's their family home. They've been there years. They've got their clubs. That's their life. They love their home. That's where equity release can come in like a dream, because it just then can clear down that mortgage and they keep their home. So that's the main thing that equity release is being used for.
okay.
And cost of living, that's another one. Obviously, that's been very tricky over the last few years. So you might be able to release money for cost of living. And then the third one is helping family. So, you know, your children, grandchildren, if they're falling short on the deposit, they're gifting the money to them. So they're sat on their asset. I think that's called, is it cash poor, asset rich, or something like that, isn't it? But that's the reason, to be able to help children and grandchildren, because at the end of the day, you can't take it with you. So if you can help your family now, you're almost giving them their inheritance earlier. There's obviously tax implications around that, which I'm not a tax advisor, but that's part of the fact finds and advice that we can do as well, just to get conscious of compliance with that.
Yeah, of course. You don't want to get caught with your compliance team as well. Can you imagine? This video is going to have to go through 2 compliance teams before it gets out in the world. So if you're watching this, we've managed to tick all the boxes.
Oh, crikey.
Keep our fingers crossed we haven't completely wasted our time.
Oh,
excellent. Okay, well, really lovely.
It's always lovely speaking to you anyway.
Yeah, lovely to chat with you too, Kelly. I know we've had a few glitches, but I've heard everything you've said. So when my VA comes along and does all the subtitles for this, we'll make sure that everything is there. And we're going to get your contact details put at the end of this as well. So if anyone wants to contact you directly, they're free to do so. My contact details will be there as well if anybody wants to talk about anything as well. And yeah, thank you so much for giving up your sunny evening.
You're welcome. Thank you.
Yeah.
I think hopefully this is a bit of an insight, because it can be a bit daunting, but I think the main thing is, if anyone's considering the equity release side of things and they're unsure or they're scared, there's nothing to be scared about. It's a chat with me and a coffee. It's worth doing.
Yeah,
definitely. Yeah, thank you very much.
I love the way you describe that to people. All you've got to lose is your time and a coffee for me.
That's it.
That's brilliant. And that's why I wanted to get you on here, because mortgages don't need to be scary, whatever space they're in. And I just wanted to share that information out there, that we're open to chats, and we can give away all that information about people's individual situation, and they can understand the facts, and then they can make their decision. And we do a lot of cross comparisons as well. So I'll be looking at one side of the mortgage, you'll be looking at the other, and then people can make their decision on what's actually more suitable for their situation. So we're not, although I think technically we could be classed as competitors, but I think we work really well together. So yeah.
Yeah, definitely,
Yeah.
definitely.
Fabulous. Okay. Well, thank you for your time. I'm going to try to end this quite graciously now. And yes, I will. Thank you for watching, everybody. And please do get in touch if
Yes.
you need to. Thank
Thank you. Bye.
Equity release will reduce the value of your estate and can affect your eligibility for means-tested benefits.